Hello and welcome to our next 7 Investment Management discussion about, well, what we're doing next. We've always actually built our business on the basis of providing professional services to professional planners and advisors. So we're constantly evolving and changing what we've been doing. Now we're coming on to the next evolution of this, a new style of fund which we're calling the Unconstrained Fund. That's what we're going to discuss today. So Tom, we've developed over the years by having a steady process and discipline about our investing. Now we've got the Unconstrained Fund. How's that going to be different?
The structure and the process that have come to be the hallmarks of 7IM have served us and have served our clients very well. We've had 4 different levels of risk. Each level of risk has had a very broad asset array. Each one has had a neutral position and we can tilt it. Each one has had an expected return and a range of portfolio volatility. The decisions were made by a team, not a star manager, and everything about what we do and we will continue to do with the risk-rated funds from 7IM is structure, process, steady, long-term, durable, repeatable, reliable, safe pair of hands.
Which is great. So why change?
Some people have asked us, could we be a little bit more forceful in expressing our views in our portfolios?
And when you say forceful, does that actually mean more adventurous, take more risk, or what?
It does from time to time, yes, absolutely. And the structure and the process that we have puts boundaries around the risk that we're able to take in the risk-rated funds, and they are there for good reasons, and they should stay there. What we're doing now is to create another investment vehicle which allows us in the same portfolio to travel up and down the risk spectrum as and when the people running the fund think that that is appropriate. Therefore, this is not suitable for conservative clients because there could be moments in time where it's very aggressively positioned.
But we're also saying it's not necessarily always more adventurous, because we've been accused sometimes of actually having an adventurous fund that wasn't very adventurous. So this could be, but on other occasions it might not be.
It could be 100% cash at a given point in time. So, yes, it could be extremely low risk. It could be extremely high risk. And it will travel up and down that spectrum depending on what our view of the world is and where we think the best opportunities are. So whereas we run the current risk-rated funds to asset classes and regions and manager styles, we're going to run the Unconstrained Fund to strategies.
Right, so how does this vary? Previously we focused absolutely on getting those risk-rated structures sorted out by way of clear asset allocation. Is this the same?
Well, the asset allocation clarity in this one is going to go away by design. So we're going to be able to change the asset allocation markedly when we think it's appropriate. So what I've done is I actually went down the hall just about 10 minutes ago, talked to the investment management team, who's just right now in the midst of putting together the opening trades for the fund. And I said, just take a couple of minutes out and talk to me about what it is that you're doing for the opening positioning in the fund so I can give you an idea of what it might look like.
So what do you mean by strategies? How does that vary from what we're doing now?
So strategies in the Unconstrained, right, will replace asset class and region in the risk-rated. So instead of saying I want a certain allocation to North American equities, large cap, right, what we'll say here, and I get an example, is we want a certain allocation to the Euro crisis resolution, right? So our belief is that the euro is not going to implode. We believe it will muddle through. We believe they will gradually find the way through the difficulties that they've got themselves into.
So you take that issue, that strategy,
yes,
and then you populate that strategy with particular assets.
Yeah. For example, Italian debt.
Right.
Right now, what we've seen is that Italian debt's 10-year Italian debt has been over 7% and has recently gone below that. And we find that the ECB, the European Central Bank, has constructed a capability of lending vast amounts of money to the banking system, the LTRO. The first tranche was about $500 billion. We're expecting momentarily about another $1 trillion to get lent. And largely what the banks are doing is borrowing at 1% from the ECB and buying sovereign debt.
But I get the point of what you're investing in. But technically, though, this strategy, therefore, could be populated by just about anything.
Yes.
So you could actually go to equities or commodities or whatever you wanted to have, or cash.
Indeed, indeed. So we right now on the resolution of the euro crisis strategy are buying some Italian and some Spanish sovereign debt. Another strategy is corporate balance sheets seem to be the lone bright spot on the horizon these days, and that translates in two different ways: corporate debt and corporate dividends. So on the debt theme or strategy that we have, we're looking at high yield and investment grade corporates pricing in levels of default well beyond what we think will actually happen. So therefore, we are riding that strategy and buying chunks of high yield and investment grade corporate debt in the portfolios now.
And in this case, then, what about that geographically? Would that be in Europe? Is that in the UK? Is that in America?
In the dividend strategy, we're finding it in Europe and in Japan, the ones that we think are the most mispriced. And in the high yield corporates, it's more geographically spread in that, including a chunk in the US.
And would these include active managers as well as passive managers, or these direct stocks? How would you try and structure that?
We can have exposure to either. And in this particular case, we're buying instruments that zero in on the countries, so that the dividends are actually structured products in this particular case, but of course without all the retail charges because they're going into an institutional style fund, which is ours.
Okay. So the whole concept then of having several strategies, and you said, I think, there were 5 of them?
Yeah, another one is precious metals. So we believe that precious metals will react gold to both the fear of inflation and to political stress. So the problems that we could or couldn't have with Iran and the Straits of Hormuz, for example. But more importantly, we're seeing another round of QE on the horizon, and the fear that eventually that's going to lead to a fair bit of inflation. So the fear of inflation, the fear of fear itself in terms of political stress, leads us to take a position in precious metals. And then lastly, we also, on the equity side, in addition to the dividend theme, we also have some regional exposure to the U.S. because we think that the U.S., if I can say it this way, has not been austerity to death the way that Europe has, and hasn't been built up the way that the BRICS have.
So therefore, for advisors and their clients, we've now got a beast which is a very different colour from our normal disciplines. How do you reckon this would actually fit in with people's portfolios?
People at the higher end of the risk spectrum, so a little bit of this maybe for balanced, but growth or very adventurous clients, we think this is probably appropriate for them to have 5-10% of this as a different style of management, and to get some style diversification into the portfolios, and diversification in the whole hopefully will reduce the overall volatility for those clients.
But without upsetting their risk profile, though, so the advisor doesn't have to go back and adjust the risk profile in some way?
No, but again, we're recommending this to larger clients only, so we're recommending this to clients that not only are at the upper end of the risk spectrum, but also have a level of sophistication and or capital that would allow them to do that. So in our own discretionary business, we are advising this is appropriate for clients initially with $1 million and up. Individual advisors may choose a slightly lower limit than that, but directionally, we want to make sure that people can understand that this can go into a very wide range of risk appetites, and that people have the ability to understand that.
Okay. How are you investing in it?
I will be.
So, Tom, with all these developments on the Unconstrained Fund, what's the sort of time schedule from here?
It's alive now, Justin, so it's available through 7IM in the discretionary management portfolios, and starting in March, we expect it to be available on other platforms.
Okay. We'll have more details on this in the next few weeks. If you'd like more information, then please do come through to the intermediary sales team. Meanwhile, there'll be some more information on the website, and I hope you find it of interest. And please, by all means, if you've got any questions or queries, do let us know directly. So that's the long and the short of our Unconstrained Fund. I hope you find that of interest. Tom, thanks a lot.
Pleasure, and see you next time.
Look forward to it.